Good afternoon, everyone, and welcome to today's webinar. My name is Danny, and I'm with the learning team at Cherry Bekaert. Just to go over a few quick housekeeping items before I turn over to today's speakers. For audio during today's webinar, you may listen through the phone or the computer speakers. You can choose your audio under the audio tab in the menu to the right of your screen. Turn CPE for today's webinar. Please make sure you answer all the polling questions. Make sure you click the submit button to submit your answers. Instructors will try to remind you of this as each poll appears. We will be issuing CPE for this in the coming weeks. The instructors will be answering questions in the question and answer pod. They will try to answer them throughout the webinar. Lastly, at the end of the webinar, you will get an evaluation via email. Please complete the course evaluation when you have a chance. So that's all for the housekeeping announcements, and I will turn things over to our instructors.
Right, thank you, Danny. Hello, everyone. Appreciate your joining us today to talk about year-end tax planning for businesses. And for some businesses, this has been a great year, and for many businesses, this year has not been a great year, but we're going to talk about planning for both situations. I'm joined today by my colleagues, Megan Hutchinson, who's a tax partner in our Raleigh office, and by Eric Pilcher, who's a tax partner in our Tampa, Florida office. And they're both going to share their insights into some of the activities here and things that they see with their client base and in their areas of industry specialization. As always, this is not a comprehensive review of any development. We're going to hit highlights, so please do not rely on this webinar information. Consult with your tax advisor before implementing any of these planning ideas or taking any actions, because your particular circumstances may require a unique or special planning action or direction. So just quickly, today we're going to talk about what happened in the Families First Coronavirus Relief Act and the CARES Act. We're going to talk about companies with financial losses this year. What kind of planning can they engage in? Then we're going to talk about companies who have been more successful and a more traditional approach to year-end planning, that is accelerating deductions and deferring income. Then we're going to hit some special deductions and tax credits, and finally finish with just a few highlights about some other areas of income tax outside of federal taxes, covering our state and local tax, international tax, and what's happening with M&A. So we're going to touch those topics briefly at the end. So let's start first with the federal employer payroll tax relief. There were a number of provisions that first started with the Families First Coronavirus Relief Act that came in early or in mid-March, that with the employee retention and the family medical leave payroll credits to employers who had employees that they were having issues with the coronavirus, some reimbursements, if you will, through payroll credits for employers who were paying their employees while they were out sick or on leave or quarantined or had issues with children. Then in the Coronavirus Relief Act, there was also added more relief, more credits for employers, and then also the payroll tax deferral for the employer portion of Social Security could be deferred and paid half at the end of 2021 and the second half at the end of 2022. Those are still very powerful tools to help with cash flow. And even if not taking advantage of it on Forms 942 as they were filed this year, there's still an opportunity in this last fourth quarter filing to take advantage of these credits and the tax deferral program. Just a couple of quick notes when it comes to tax planning. If the wages and health expenses were reimbursed to the employer through these credits, then there's no deduction for those expenses that are reimbursed through these credits. And similarly, if the payroll tax is deferred, then there's likely no payment until that tax is actually paid. So, there's no deduction until that tax is actually paid. So if you want more deduction, you may want to go ahead and pay some or all of that deferred tax before the end of 2020 if you need some additional deductions, or just note that that is not going to give you a deduction for this year if you're taking the option to defer the payments out. The CARES Act, which came through shortly later in March, provided a number of opportunities which are extremely helpful. One, we finally got that technical correction to the qualified improvement property class life to 15 years instead of 39 years, which also made that property eligible for bonus depreciation. The CARES Act temporarily removed the 461L limit on the excess business losses. So again, that comes back into play for businesses starting next year in 2021. So this is an opportune year to go ahead and create some additional business losses because they won't be limited this year. There were some changes to the interest expense limitation, some easing of that limitation to allow more interest deductions on the 2020 returns. There were some changes to the limits for charitable contributions and some other aids to help businesses and individuals make additional contributions this year and receive tax deductions for those. And probably one that we saw a lot of advantage of was the expansion of the NOL carrybacks for 5 years. With the Tax Cuts and Jobs Act, the NOL carryback period was eliminated and you would only carry forward and from 18, 19, and 20 forward. But now there is an opportunity for these 3 years to carry back NOLs up to 5 years. And some of those were some high tax paying years and refund monies from those earlier years. And we saw a good bit of that. And we'll mention briefly about PPP loans and the PPP loan forgiveness opportunity that will exclude that income from taxability when those PPP loans are forgiven. Speaking of PPP loan forgiveness, there's been a lot of noise and consternation about the expenses. So for those businesses that received the Payroll Protection Act loans and then we're using those monies for the appropriate expenditures for payroll of their employees, for some rent, for some mortgage interest payments, then those expenditures qualify those loan amounts to be forgiven. But Secretary Mnuchin and the IRS have staked out a position that, hey, if those loan proceeds are going to be forgiven, then the expenses that generated that loan forgiveness are not going to be deductible. And first they issued notice 2020-32 back in April, and that got a lot of noise, particularly Congress saying, whoa, that's not what we intended, that's not what we meant. And then just a little while ago, they issued Revenue Ruling 2020-27 and a revenue procedure doubling down on that, saying, yes, no, we really mean it. If we're not going to let you take those expenses, we think it's good tax policy for you to disallow those expenses. Now, the good news is in one of the bills that's rolling around in Congress right now that would provide some additional relief measures for coronavirus includes a provision that clarifies Congress's intent that the expenses related to the PPP loan forgiveness are deductible. So that would overrule these notice and revenue rulings and revenue procedures. But we'll just have to wait and see if that gets passed, or if we have a new administration and there's new opportunity to overrule these positions in the new year. So that brings us to our very first polling question. Danny, if you'd like to go ahead and get that loaded. And the question is, what is the carryback period for net operating losses generated in 2020? These special rules allowed by the CARES Act. And we have a couple of questions come in. I'll try to address those. Does the net operating loss carryback for, here's a hint, 5 years, provide any benefits for LLCs? Well, not for a pass-through entity itself, but if that loss flows through to the individual owner who has to report that loss on their own return, if they're able to claim all of that loss in the year, they can then qualify for the NOL carryback for 5 years. So that's where the opportunity, it flows not from the pass-through entity itself, but out to the owner, who then may be able to carry that back and recoup some taxes paid on income from that LLC that was reported in those in that 5-year period. So the question came in about PPP loans. If the loan and payroll happened in 2020, but forgiveness doesn't happen until 2021, in which year the payroll is not deducted? That's a great question. And that's what that revenue procedure is about. It says that, you know, the plan is, under the revenue ruling, you would not deduct those expenses in 2020, the year that they're generated, if you have a reasonable expectation of reimbursement in 2021. You know you're going to apply for that. But the revenue procedure says, if you are not sure, not clear if you qualify, or you're waiting to see if it's going to be qualified or not, or then you have the option of not deducting those expenses in 2021 when your forgiveness is secured. So let's go ahead and show. I think we've had enough people respond to that poll. If you want to share the results there, the answer is 5 years. 5 years is the maximum amount that is allowed for carryback. All right, Eric, why don't you tell us what can be done for companies that have had some financial distress and some losses for this year?
Yeah, thanks, Sarah. Appreciate that. So, you know, there's some things, you know, normally, you know, when you have the type of situation where, you know, sort of a loss situation, you know, what are the things you can take a look at in order to help? You know, is there a way to potentially accelerate some things, you know, to incorporate some items into your year-end planning? So kind of wanted to walk through those and some of the pitfalls to be careful with too as a result of some of that. The first one is sort of in regards to bad debt deductions. So, you know, those are the, you know, it could be, you know, an AR, could be certain things. Maybe you made a loan, you know, to a related party, or maybe to a, you know, former employee, you know, it could be anything along those types of lines. You're making a loan, whether it's business related, the AR, or some of the non-business things, some of the other items. The key part about that, though, is obviously going through those and being able to actually write them off. You know, any amounts that are reported as reserves, those amounts are not deductible. The IRS specifically requires you to actually write off the debt itself in order to be able to take that deduction. So, and it could also be a partial. You know, if you've gone through and say, you know, it's $100,000, and and you've determined that you can only collect 70 of that, then 30,000 of that AR in this case could be written off as an actual bad debt deduction. So it's important to make sure that you're going through and really identifying what can be written off as opposed to what a reserve would be, because that would be non-deductible. Next item is sort of a business, property, or investments. It could be something where, you know, you've got something for, you've had it for a while. It's not, you know, increasing. Maybe it's something you're not going to be able to use. You've had to actually abandon the property or abandon the activity. Actual abandonment of those activities or those investments, you can claim the losses on those. You know, whether that means you're just turning it back over to, to a bank situation, or say it's an investment and you're just completely walking away from it. You know, we've even seen some situations where maybe you owned a piece of property and you were doing some work, maybe to get it ready for a building, but you sort of abandoned that activity for the time being. You still own the property, but you're like, I'm not going to do any building on this. Those costs are sunk. I'm not going to be able to use them going forward. For any reason, you know, maybe you have architectural plans, anything like that. Those items can actually be written off, you know, as an abandonment of an activity. So it's important to be able to take a look and see, is there something that you can do for those? The next item is something that we've seen, you know, you've seen normally when you hear about disaster losses, you're thinking about hurricane, tornadoes, maybe a fire situation, flooding, you know, all those kinds of situations. Well, you know, they've kind of come out and they said, well, what about the pandemic? You know, because you can take a disaster loss in an area where there has been a federally declared disaster. Well, when this pandemic started, the president declared the entire country a federally declared disaster area related to the pandemic. So you sort of cross the first threshold because you're covered by it if you're in the United States. So the second part is that can you tie the loss specifically to the disaster? That gets a little bit harder because you have to be able to specifically say it was from the pandemic that caused the issue. As an example, I had a client where they were a produce distributor, and because of all the school closings and the cruise ship industry, not even, running anymore, their perishable items had to be thrown out because they rotted. They were no good anymore. So they were able to take a specific disaster loss on their 2019 return, because you can actually take those losses even the year before. You can take it in the year before they actually happen. In this case, since they happened in 20, we could take it on the 19 return. So it is something to keep in mind as you're going through, not only the timing to be able to take the deduction, but also, do I have something specifically related to the pandemic to do that? So that's definitely a facts and circumstances as to whether someone would qualify. The next couple items are related with loan foreclosures and also cancellation of debt income. If you have situations with foreclosures, depending on whether or not there's personal liability for purposes of recourse debt, or seller financing debt, it's really, those rules are pretty complex. So you have to make sure and go through what are the implications if I foreclose on this property, or if this debt, if I get the property back, do I have to write it down? Do I, what is my basis going to be coming back? So it's important to keep those in mind as you're going through those, as to what the implications will be for both sides. And in tandem with that, and the cancellation of debt income, if your company is, if the bank or someone that you're working with is canceling some of the debt and you're not required to pay it, that actually will be income. It kind of goes back to the comment in one of the previous slides, is that if I don't have to pay the money back, then, in this case, general debt, it is going to be an income hit. So it's important to make sure and not only what amount is being written off, but also specifically when. Is that happening at the end of 2020? Is that happening in 2021? Making sure that you're working with whoever the lender is, so you know exactly the time frame about that. And then going back to what Sarah was talking about too, with the NOL carrybacks to recover the taxes, it's important to remember that those NOL carrybacks are, the last year of those is 2020 losses. So if there's something that you want to do a carryback on and you're going to have an NOL, 2020 is the year that you want to try and get as much of that loss in there. Because if it goes to 21, it's just going to be a carry forward loss, because the previous rules come back into play and it'll be a carry forward at that point. So it's important to know the timing of when those losses are going to be. So you may want to accelerate some of those deductions to get them in the carryback year. Okay, so moving on to sort of the debt modification. So that's what we were kind of talking about. There's going to be something with some debt adjustments. So maybe you have, there could be an exchange of old debt for new debt. So maybe, you have a situation where you had a previous debt with certain yield, certain timing. Maybe there's certain security that's changed. They're looking at all those components to say, okay, is this really just an exchange of old debt for new debt? Because in that case, you can have those modifications can cause some issues, versus is it something where maybe you're just getting, say, an extra 6 months to pay? That may not be deemed to be, depending on the facts and circumstances, that may not be deemed to be a change. Because if you have an old debt and a new debt situation, you can have COD income on the old debt and OID, so you can have some additional interest calculations on the new debt. I would say that it can get pretty complicated on something like that. So if you do have a situation, you'd want to contact your tax advisor or your accountant to kind of go through the different steps of what it is that's going to change, because it could be nothing, or it could be pretty significant, because you could have a lot of adjustments without really realizing it. So let's say we got a situation though, and you have a company's got all the losses it can use. Let's say if I do a carryback, I'm going to maximize the amount of the NOLs that I can carry back and cover all my taxes. And what can I do if I also think the tax rates are going to rise going forward? With the new situation on the with the new government, the new president, we could have a tax rate change. Well, what are some of the things you can think about for purposes of dealing with that? You can opt out of bonus depreciation. Bonus depreciation, takes 100% of your assets and depreciates them on the tangible property, and even some real property now. You can opt out of that and take it over the normal, say 5, 7, 15, whatever time periods that you cover. So it can push those deductions out to further periods, maybe with lower tax rates, with more expensive tax rates, you can save taxes. A couple of the other items, capitalizing costs rather than deducting them right now. You can capitalize them under inventory under the 263A rules. The other thing being research and development expenses. Rather than deducting those today on the return, you can capitalize them and amortize them over 5 years. So you can push out those deductions to receive the benefit to potentially offset, more taxes. The other one being is delay paying bonuses and other accrued expenses. So that scenario of, instead of paying those year-end bonuses in, December, maybe some of those get paid out, further into 2021. So those deductions are actually taken in the year that they're paid rather than, being deducted in the year necessarily where they're being accrued. Same thing from a cash basis taxpayer. If you paid it December 31st versus January 1st, you obviously have two different time periods there for your tax return. So you can defer those out and push those into another period. The other thing being on the flip side of that is accelerating some revenues. Maybe you've got, like I said, as much deductions as you can have, and I'm worried that I'm going to pay more taxes in the future on the revenue side if the rates go up. So I do additional invoicing. From the accrual side, I send out more invoicing at the end of the year. From the cash side, I make sure and try and make a push for collections and pull those payments in before year end, as opposed to waiting till January to make those to collect those amounts and make those deposits. The other thing being is that maybe you're thinking about changing to the accrual method. Maybe there's just something, like I said, if you're changed to the accrual method, all that AR that's out there, that amount can be pulled forward and accelerated into income as opposed to being pushed out for cash basis. If I can, gobble those amounts up because maybe I have some losses to offset against that. The flip side for that too is whether or not you would have an inclusion method. So right now you could defer out some of those advance payments on the accrual method for a year. Well, maybe I would actually make that full inclusion. So rather than pushing those payments out, I actually recognize them as income today. You can do that even though you're still on the accrual method for otherwise. So you can do that sort of full inclusion. The other thing being is that not deducting those PPP loan expenses. Obviously, as we sort of mentioned that earlier, there's some from the IRS's perspective, they will never tell you not to worry about that because they would that's their position anyway. So not deducting those expenses would increase your income because you're pushing those out to either pushing them out or not deducting them at all. So there are a few things to be mindful of when you're talking about pass-through entities. So when we're talking about the S corporations, LLCs, partnerships, even though, say, I may take the loss on the pass-through entity's return, can I take that deduction on the partial individual's return? And there are sort of, there are multiple things that sort of incorporate into that. And these are sort of like 3 steps to kind of get through. I have to have enough basis at the individual shareholder partner level. I have to worry about the at-risk rules, so whether or not I'm economically at risk to deduct it. And then I also have to worry about the passive activity loss rules. So you have to make sure you get through each one of those buckets first. And that's going to be on a case-by-case basis, even sometimes an actual just investment by investment basis per person to determine whether or not you can get through those buckets to be able to get to those losses. Now, let's say, the easiest one to sort of account for is in regards to basis, because basis that's the first one. If I can't get through that, the others don't matter anyway. So maybe you've got some basis limitations at the shareholder partner level. You can maybe consider making loans or capital contributions before year end to boost that owner basis up. They can push those out, to push those amounts up to take some of those losses that they may not have had. Because if they don't have basis, they're going to be suspended and carrying forward, and they're not getting that current benefit, especially if you're trying to do those NOL carrybacks. The other thing is that maybe they don't have a lot of basis, and maybe they have they can defer deductions or accelerate income. Because you can generate basis by either putting in the loans or the contributions, or if I'm able to generate income, then I can increase my basis as well. So consider, making those adjustments to help the purposes of the basis, because maybe they can, maybe they can push those amounts and maybe free up some suspended losses from prior periods.
All right, I think that brings us to our second polling question. Danny, if you want to go ahead and get that up there for us. And so the question for a tax year that is full of financial losses, taxpayers what could they choose? They could accelerate income, they could defer some deductions into the next year, they could capitalize some R&D or research and development expenses, all of the above, or not sure. So give us your thoughts on that. What steps a taxpayer could take if they have already had all the losses they want and all they can absorb for the tax year. Some actions to take. It's not often we talk about situations like this, but knowing that so many taxpayers businesses have struggled this year, we wanted to make sure you knew that there was some planning that could take place. And if you wanted to create some additional losses, there is a there's a school of thought that says, hey, if you're going to have a bad year, go ahead and have a really bad year. So this could be that opportunity. And great, I see most of you have said all of the above. So that's excellent. All right, let's turn the page now. And Megan, talk to us about the more traditional approach. We've got income, we've earned income this year. What can we do to lower our taxes? What's our options?
Thanks, Sarah. Yeah, so if your business is profitable for 2020, then you're considering accelerating deductions, pushing income to 2021, tried and true tax planning right here, 101. So of course, accelerating deductions are going to help you reduce that overall tax base. So we want to highlight just a few areas you might want to consider. Inventory, reserves, subnormal goods. You may have already written off and disposed of a bunch of inventory this year. If you're still hanging on to some inventory, now might be a good time to take a look and see if it should be disposed in order to claim some deductions for the year. With reserves, just putting one on the balance sheet isn't going to be enough. You have to truly get rid of that inventory before the end of the year to claim that deduction. There is an exception for subnormal goods, which by definition is just inventory items that they're unsellable at normal prices or unusable in the normal way because there's damage, imperfections, etc. Basically, they're items that they just can't be sold anymore. Nobody's using them. If you have a warehouse full of floppy disks, nobody's buying those. So their items are just fine, but they're obsolete. So if you have those types of goods, you have to separate them out and offer them for sale, but for less than cost. And if you can offer them for sale within 30 days before or after the end of the year, even if they don't sell, you can claim a deduction for that write down in price. So if it costs you $100 to make it and you offer them for sale at $50, then you can take that write down on the inventory because you did everything you could to get rid of it. If you wanted to take it all the way down to zero, you have to actually dispose of the inventory. So there are some new UNICAP rules to consider that are pretty taxpayer friendly when it comes to production and companies that may have a lot of raw materials on hand, as well as if you had facilities that were shut down or idle machinery for periods of time. So to the extent that there was shutdown, depreciation on that idle equipment does not have to be capitalized into inventory. And there could be perhaps other non-production costs to consider. So at the end of the day, if you are a manufacturing company, there may be an opportunity to move some costs that would ordinarily be capitalized to inventory, over to SG&A and, fully deduct. Reserves and accrued liabilities, Eric mentioned bad debts and asset write-downs. When it comes to these types of reserves, we're accelerating payments before the end of the year to get deductions now. So if you know you're going to pay something in 6 months and you need that deduction today, go ahead and pay it. Bonus plans, if you're more than 50% C Corp owner or any S Corp shareholder, and you will be taking a bonus this year, make sure that bonus is paid by the end of the year. It has to be paid by the end of the year for the company to have that deduction. Now, if that bonus is for just an employee, you just have to make sure it's paid by March 15th of 2021 to make sure that you have that deduction for the 2020 tax year. And then on retirement plan side, the SECURE Act brought in a bunch of new changes to retirement plans during the year. So now it's definitely a great time to take a look. Maybe you don't have a plan in place, or maybe you've been considering changes to it before year end. It may be that you want to make certain contributions that can be deductible and taken on that 2020 to reduce that overall tax base. Cost recovery, depreciation, depletion, amortization, all that good stuff. 100% bonus depreciation, I think for most taxpayers, this is the best thing ever. So now it's used and new equipment, new property. So a lot of before the Tax Cuts and Jobs Act, you needed to look to 179 expensing, especially when you were looking at used property. So now we're able to take that 100% bonus on new and used property, which we couldn't always say. And like Sarah mentioned earlier, we finally got that clarification on QIP, qualified improvement property, where the TCJA inadvertently made it ineligible for bonus depreciation. Well, now we know it's 15-year property, it's eligible for bonus. So what is that QIP? It's basically any improvement to the interior portion of a non-residential building, as long as the improvements do not increase the square footage, which I think is the biggest piece, alter in the internal structure of the building, or it does not relate to an elevator or an escalator. So if you had those types of improvements in 18 and 19, where you didn't take bonus depreciation on them, you can go back, recalculate, catch up on that missed bonus depreciation, and take that in 2020 with an automatic method change. So just a couple of other areas that can get missed in terms of cost recovery. Take a review of the fixed assets and some of the data that may have been entered. Maybe an asset was miscoded and given the wrong life or the wrong method. You can correct that, and similarly to the QIP, get caught up on those depreciation expenses in 2020. Review and consider your placed in service date. So to get that depreciation expense in 2020, we need to make sure that the asset is placed in service by the end of the year, meaning that it's ready to be used and it's being used for its intended purpose by December 31st. Of course, cost segregation studies, hugely beneficial, taking those long-lived real property assets and pulling out some of the short-term 5-year, 7-year property that you're able to take 100% bonus depreciation on. Identifying deductible repairs. If you've had a lot of capitalization activity, including repairs for book purposes, there may be opportunities to take a look at those and pull those repairs out and deduct them for tax purposes. Sarah, next slide.
Oh, great. Let's talk briefly about the changes that happened to the interest expense limitations under 163J. I like this chart because it just shows you that every year something different is going on. And for 2020, the good news is that the limitation has been raised to 50% of adjusted taxable income. So a chance to sweep some more interest expense through as a deduction this year, and a couple of special treatments for partnerships that are going on. But just know that there's no straight answer in any year as to how much interest expense can be deducted. That's why I like cost recovery. It's a bit cleaner, and you're a little more certain with 100% bonus depreciation. One of the good news that happened in the final regulations for this code section is a provision that allows for depreciation, amortization, depletion that is capitalized into inventory can now be considered in adding back to get to adjusted taxable income. Before now, the service had taken the position that no, that is not depreciation, amortization expense to be added back in increasing the adjusted taxable income and allowing more interest expense deduction. They said, no, that's over in inventory and that's in cost of goods sold. Well, it really disadvantaged our manufacturing clients and companies versus a retailer or a service company. So the service in the final regulations relented and said that, hey, even beginning all the way back to the beginning of 2018, when these new limitation rules kicked in, will allow you to go back and recalculate and take whatever the current year's generation of depreciation, amortization, and depletion that was included in that capitalization. We'll let you add that back and thereby increase your interest expense deductions. But on the flip side, when you dispose of those assets, we're not going to let you take that whole gain. We're going to make you reduce the amount of gain recognized. if you sell one of those assets that's being depreciated. So good news for, in particular, for our manufacturing clients. Lots of choices going on this year when it comes to interest expense, all intended to allow more interest expense deductions than in prior years, but just know that it's a little more complicated and there's some choices to be made. So thinking about what's your overall plan and what's happening in 2020, do you want to create more deductions this year to maybe carry back as a net operating loss? Or do you want to postpone and push out interest expense deductions into subsequent years, future years, when you may be generating more income in those years and could use the deductions, or we may anticipate higher tax rates or other law changes in the future. So things to think about and talk to your advisor about in planning your interest expense deductions. So Megan, back to our regular program. What do we do about deferring income?
Yeah, this is all, as Eric was speaking earlier, this is all the opposite of what he was talking about with your, a loss company. So deferring income, pushing this income out to the next tax year. So slowing down kind of your collection efforts, maybe delaying the services or mailings to your customers until the end of the year. If you're accrual basis, perhaps you can elect that 451c, defer that advance payment for a year for tax purposes. So if you're expecting to receive some grant income or funding for projects, maybe talk and see if there's any way to defer the receipt of that grant until January of 2021. And then if you have losses that are deferred, go ahead and start thinking, is there any way to kind of trigger those losses and take those into 2020? And then lastly, simplified accounting changes. There were a number of changes that with these gross receipts limit went up to 26 million with the Tax Cuts and Jobs Act increased this limit by quite a bit, allowing taxpayers to change some methods that are generally going to not only potentially generate some savings, but oftentimes save on compliance cost. So if you are, for instance, if you're an accrual-based taxpayer and you're sitting there and you tend to be AR heavy at the end of every year, maybe you should be considering making this election and changing to the cash method. So take a look at your balance sheet, take a look at your gross receipts and see which one of these methods and see if it may not be beneficial to you to change.
All right, Danny, we're up to our third polling question. For a tax year with lots of taxable income, taxpayers may want to defer income by delaying new job starts until 2021, claim bonus depreciation on new equipment, write off some bad debts, and dispose of worthless inventory. All of the above or not sure. We did have a question come in about interest expense limitations. Just as an example for 2020, most businesses will be looking at a 50% of adjusted taxable income limitation. So for example, if taxable income is 100,000, and to get to that 100,000, there was a $20,000 depreciation deduction and $10,000 for interest expense, then we would add those items back to get to adjusted taxable income of 100, and that would be 100 plus the 20 plus the 10, get to 130,000 times that 50% limit, which would be 65,000. So the most interest expense that could be claimed for that year would be 65,000. Now, in the example I gave you, the limit, the amount of interest expense was only 10,000. But what if the interest expense for that year had been 100,000? Well, we would still be limited in how much could be deducted in that 1 year. My math doesn't work out quite. I really need to write down an example to make that work. But you see how this works. It's not just taxable income, but you add back some things to get to adjusted taxable income, and then that caps that. And the whole idea is to sort of make sure that everybody has that's deducting interest expense is really deducting interest and not something that might look like a dividend or some other sort of interesting return of capital type transaction. All right, I think great. So most of you said all of the above, and that is excellent. So Eric, we've talked about deductions and income and losses. What about some special unique deductions and some tax credits?
Sure. So there's a couple things that have come up over the last probably two years now. First one is in regards to what they call qualified opportunity zones. And as you can see, sort of on the screen, the key component here is that you have someone receiving a capital gain, but you're able to defer that income to the future. So you're able, as long as you make an investment within 180 days into what they call a qualified opportunity zone fund, and then the fund itself is investing in something in a qualified opportunity zone project. Those where the funds, or specifically where those projects are, they're investing in specific zones which have been identified, and they're going to still exist for roughly the next 10 years for purposes of where those zones are. And they're really, it's where they're trying to get sort of economic development into, to increase some of those areas. So you're able to defer those gains by investing the money, and you're only having to invest the gain money. You don't have to invest, say, the money related to your basis. It's just the gain itself, putting that in and be able to defer the income. And the key part that kind of notes at the bottom there is that it's not just for individuals. It's who can actually participate in this? Individuals, C corporations, REITs, partnerships, S corps, trusts. Basically, any type of activity or any type of taxpayer can actually invest in this. And actually, I take it back. In addition to, it's not just the taxpayers. We see the partnerships and the S corporations there. Actually, the pass-through entities themselves can do that. So if you have an activity or a flow-through entity that doesn't want to necessarily break up, they want to use the money for to invest in something else. The S corporation, the partnership, it can be the one that actually takes the money and actually defers the gain. So the next part is, so let's say I have a deductibility, or I have a gain that I can defer. What's eligible? 1231 gain. So that's the gain when you're selling your trade or business assets, and or capital gains from any sales of stocks, bonds, assets, real estate, collectibles, any kind of those items, that's eligible. Short-term capital gains. So it's not just long-term. You can also defer short-term capital gains. So it keeps the same character. And some 1256 contracts, but it's only the gain when you have net capital gain income in that year. So not when you have the losses, because sometimes you'll have gains, sometimes you have losses, goes back and forth. And then the other part is the gain, gain recognized prior to 1/1/27. That's the last time these opportunity zones exist. So at that point, the gain itself would become income, but you're able to defer it out for an extended period of time, because between today, 2020, and the beginning of 27, that's obviously a fairly significant time period. So you're able to push those out. There are some things that are ineligible. 1245 recapture from the sale of personal property. That's the depreciation that you're taking on that tangible personal property. The recapture on that from the depreciation on the sale, you cannot defer that. You would have to recognize that gain. And also gain from sale of assets to related parties. They don't want you to be able to sort of sell it to a related party, have the gain, be able to sort of get a step up to the related party to the fair value, and then not having to recognize that gain to offsetting it way into the future, while the related party's getting the benefit today. So you're not able to do that. And also when you have straddles, offsetting transactions, you can't do that. You'll see those between some investment activities is normally where you're going to see the straddle, but those are not eligible. So carried interests. This is something that you'll kind of see primarily in partnerships, occasionally within some S corporations. The carried interest, you hear about this a lot of times when people are talking about sort of private equity or the sort of investment vehicles. They're assigning a profits interest to a partner, usually a general partner, as a compensation for services to the partnership, sort of a sweat equity. They're not putting the capital in, but they're the ones that are directing the investment, managing the investments, making sure everything's working through. There's a specific rule change that was made a few years ago now, where in order for that interest, so that partner on that carried interest that they're receiving, that payout they get, they have to hold that interest for 3 years in order to have a long-term capital gain. Normally, if I hold any sort of investment, I only have to hold it over a year. But specifically for carried interest, you have to have them hold for 3 years before you get the long-term capital gain treatment. So you have to be careful if you have that type of situation. You have a little bit longer time frame that you have to make sure to be able to hold that before the investment, before it closes out and before you get paid. Obviously, you have to consider the timing for the dispositions. There have been some proposed regulations issued specifically on this issue. So if it does apply, you want to make sure you're going through those to see if that's your type of situation, since there is a lot there. For federal and state research and development tax credits, right now, even though there's been a lot of obviously situations where the pandemic's been a lot of problems, there have been a lot of companies that have had to pivot. They've had to do certain things. You've seen those kind of stories where maybe like a liquor company is pivoted into making hand sanitizer because of the alcohol content. Those types of innovative, moves like that can be something that can actually be a research and development credit for purposes of what the situation we're currently in, and being able to take that. And you can take it in one of two ways. If you're an existing company who's been doing a lot of, activity, it's had, revenue, had a lot of activity over time, you can use that as an income tax credit. And there's at the federal level, and then also various states have their own income tax credits for purposes of R&D work done inside of their states. If you're more on the startup business side, where you either don't have revenue or it's very, very small, you can actually claim that credit against your employer payroll tax liability. So it allows you to monetize that credit today rather than having it carry forward to some point in the future. You can use that against your payroll tax liability. So you save cash because you're not having to worry about that as much. And then also from the state side, they have the same type of thing. A lot of states have the same adjustments where you can take those credits against state payroll tax liability. So you can get that sort of double benefit for the same costs. Okay, so the last couple of things we want to talk about in regards to the credits are some specific things in either certain industries or certain situations. The first three things in regards to credits, specifically, the first one is a solar tax credit. That's where, sort of like the picture there, you're installing, solar panels could be a commercial situation. We'll talk about those in the next couple, but in a residential situation, you can also receive the solar tax credit, to have those. There's also a lot of incentives that certain states have where they want to give you the benefits to be able to do those. And also you can work with certain utility companies in your areas, whether you can, whether you're receiving a benefit on your, the bills because you're putting things in there, they're giving you a credit for that, or you can actually, there's certain situations where you can generate enough energy for your solar taxes, actually selling it back to the utility company to receiving a benefit that way. You can actually go the opposite direction. You're actually, the utility company's paying you a little bit, which normally you don't really have. The next couple, the 179D, that's a deduction, and 45L, that's a credit. Those are related to actually energy efficiency on commercial, well, this is commercial buildings, but those are primarily where you're going to see residential. That's where that sort of 45L comes in. 45L is on the smaller ones where you're going to have 3 floors or less, and 179D is on the taller ones where you're going to have 4 floors or more. You're basically going to receive those benefits depending on the energy efficiency, within those activities. For the most part, a lot of companies actually would qualify for these. This is on the real estate construction side, so you have to own the property that you're putting together. So you have to be the owner here of the property. A lot of times those rules are actually quite old, so the energy efficiency in most areas that are required now by statute, just for purposes of construction, will qualify you for those credits or deductions depending on the height of the building. The one thing about those is those are set to expire at the end of 2020. Currently, they may be brought back, but currently hasn't happened. So in order to receive those, you either have to have the property itself, as say like it's an apartment building, you have to have the apartments themselves rented out, or it also will qualify for able to sell the building before the end of 2020, because you can still get the benefit for that because the actual transaction has occurred. The last two are some specific sort of more niche situations. There's new markets tax credit funding. That's where you've got situations where they're trying to get money into certain specific markets for economic purposes. And, there's you can receive funding for purposes of loans to actually do the businesses there. Well, maybe some of the investors can receive some of the credits, but the company itself is able to receive funding to go into those areas. And then historic rehabilitation is just like what it sounds like, where you're taking historic buildings, rehabbing them, because the government understands that, and also states have the same type of credits, they understand that, you know, it's more costly. There's certain restrictions that you have to do depending on where you are. So the cost can be significantly more than if, you know, you're rehabbing just a building that didn't qualify as historic. So they try and create an incentive for those, not only for the cost, but obviously to make sure that those buildings are well taken care of.
All right. Thank you, Eric, for that rundown on credits and the Opportunity Zone funds. Megan, catch us up on some of the issues that we're seeing in state and local tax.
So with SALT planning, obviously with the CARES Act at the end of March, and you know in the 19 there was the tax law that was passed. The states have been doing a lot of catching up with, you know, are they going to conform with these federal laws? So there is a lot to consider. There are some states that have rolling conformity and some that do not. So you have to consider whether the states you're operating in are going to follow federal guidelines. And then you have to consider, well, are they decoupling from 163J, which could be a good thing. It means all the interest is going to be deductible. But that state may have decoupled on bonus depreciation. That's a bad thing. That state's going to require you to add it back. So next on apportionment, you're not going to be able to rely on 2019 nexus and apportionment in 2020 because there's been so much change, and a lot of that is due to COVID. With gross receipts, you may not be selling into the same places. Maybe your customers were severely affected by the pandemic and they may have closed. Maybe you needed to look into new states to fill those sales holes. Your percentage sales in various states are probably not going to be identical to what they were in 2019. So if you were ever kind of looking at using prior year percentages or numbers, I would encourage you for 2020 to take a look at where your sales actually were. Secondly, you know, where your people are related to nexus and apportionment. When, you know, back in March, everybody kind of scattered to the wind and were sent home to work. And we all, I think the majority of us became, you know, teleworkers. And as of June, there's only 15 jurisdictions that have issued specific COVID-19 guidance on temporary teleworkers. So the presence of temporary employees that may alter your apportionment and create some nexus in states that you may not have had before and you wouldn't have had otherwise. M&A transactions, just real briefly, I'll highlight state impacts are often a forgotten consideration in M&A. You know, the state filings, the reporting, the apportionment of any gain to various states. So if you did have a transaction within the year, I would encourage you to go back and take a look at what state implications you may be facing. SALT cap workarounds. Many of you have probably seen and heard about the fact that, you know, TCJA limited the individual deduction for a state and local tax paid to $10,000 on that Schedule A on your personal return. So in response, some states passed statutes allowing businesses that pass through income to their owners, partnerships and S-corps, to elect to pay income tax at the entity level, potentially resulting in a full deduction for the entity and indirectly a full deduction for the owners. So recently, Notice 2020-75 was issued. So the government does hold that it will allow pass-through entities to fully deduct entity-level income tax payments, provided certain requirements are met. And part of that caveat is that the states must pass specific statutes providing for that entity-level taxation for the notice to apply. There have only been a few states that have adopted laws. Maryland is one that now has that election starting with the 2020 tax year. So if you are operating in as a pass-through in Maryland, I think Connecticut, New Jersey, maybe Wisconsin, I think might be the other one that may have enacted some statutes here. Take a look at whether or not that workaround might impact you. Of course, there is often money available for companies. If you are looking to spend capital, maybe new equipment, a new location, a new building, there can be money for that at the state level. If you're expanding your workforce, hiring more people, there are often incentives and credits. So generally those funds, when you receive them, are going to be taxable. So that's part of planning. Look for those funds and time them appropriately.
All right, before we hit our last two topics, we'll go ahead and get our fourth polling question in because we want to make sure we get these in before the end of our time today. So here's our fourth question. Does your company have employees that are teleworking from another state in 2020? Have you thought about an expansion of your nexus requirements because you've got folks working in different areas? We did have a question come in, another question about the interest expense limitations. Just know that this only applies to business, trade or business interest expense, the limitation. If you have investment interest expense on reporting on Schedule A of your tax return, of an individual's tax return, or investment interest expense in a pass-through entity, you're invested in something and paying some interest for that, and it's not trade or business, then these limitations do not apply. Now, if you are a C corporation, there is no concept of investment interest, so all interest expense is going to be subject to this limitation if you're at a C corp solution, as far as we can tell from the regulations as they're issued right now. Great. All right. I see a good portion of you are thinking about and do have issues with teleworkers in another state. Megan, catch us up on a few thoughts on international tax and then M&A.
Yeah, on international tax, there have been a ton of new regulations and proposed regs that have come out dealing with everything from foreign tax credits, GILTI, BEAT, FDII. There's a lot of things going on, and with all things international, there's just a tremendous amount of organization and reporting that goes on. So if you do operate internationally, this is another point where I'll mention that, you know, COVID may have impacted you significantly with your outbound activity as well as inbound. If you're trying to pulling materials, you may not have been able to get those from certain vendors overseas at some point this year. Vice versa, you may not have been able to get your sales out as you would in prior years. So if you have transfer pricing in place, or you're looking at any of that structure for the year, take a look back at any changes that you may have had because of the changes of your activity and the changes in regulation, you may have an impact there. And lastly, with M&A, we've definitely seen an uptick in M&A activity. And if you're already engaged in a transaction, review the tax implications now. As I mentioned earlier, SALT is often an overlooked aspect within a transaction. And trust me, you don't want to be surprised come filing when you've been under the assumption that that gain on the sale is only going to be sourced to your home state, and then someone tells you, no, you must apportion it to all of these states that you operate in. So take a look at any of those implications. In terms of planning, you know, Eric mentioned opportunity zones earlier. If you did have a transaction, you are going to have a large capital gain. I'll bring it back to those opportunity zones. You do have the chance to defer that gain if you are investing in one of those zones.
All right. Thank you. This brings us to the end of our presentation. I want to thank Megan and Eric for their input into today's presentation, and thank you for your attendance. We will hang out here for just a minute. If you did not get a copy of the slides today, they're in the handouts pod. You can go over and click on the arrow next to the little triangle next to the handouts and download a copy of today's slides if you'd like to. We'd love to hear from you, and please share your feedback with us when the survey comes out, because we'd love to hear from you, and particularly about things you'd like for us to talk about next. So again, have a very good day, and we appreciate it.